I think we're ready to begin. Hi, everyone. This is the Combat Claims Inflation in an Evolving Business Landscape. I'm Kate Wade, the Managing Director of Wade Strategy, a strategy and marketing insights consulting firm that works with organizations to optimize their growth potential. I have a CV that includes working at both Allstate and Gallagher, as well as the Boston Consulting Group and Accenture Strategy. Claims costs are rising and carriers need to constantly focus on improving risk assessment procedures and expedite accurate claims analysis to address high exposures. Here's with me to discuss what is causing these rising challenges and what they are doing to combat these issues are three industry leaders. I'm going to let them introduce themselves, starting with David Williams.
Yes, good morning, everyone. My name is, you heard Dave Williams. I'm the Chief Claims Officer for the Texas Windstorm Insurance Association, otherwise known as TWIA. TWIA is a private not-for-profit residual market insurer providing windstorm and hail insurance to residential and commercial property policyholders in the 14 coastal counties of Texas and a small part of Houston. We're not a Texas state agency. We receive no funding from the state of Texas. All insurers doing business in Texas are members of our association and are potential candidates for assessments where our funding structure needs more money because our losses exceed our funding structure. Any surplus that we have each year after we pay our expenses and losses goes into a state-controlled fund. And as far as claims, our focus is on speed, empathy, convenience, and most important, accuracy. We have a strong understanding in our claims operation that a claim stays open longer means it's going to cost us more. And for us, our biggest challenge is scaling for large claim generating events like hurricanes. So for example, Hurricane Harvey, at the time we had 48 people in our claims operation, and within 2 weeks grew to over 3,000 people working over 90,000 claims. So with that, I'll turn it back over to you, Kate.
Thanks, David. I'm going to now switch it over to Steve.
Good. I guess it's good afternoon now. My name is Steve Donnelly. I'm the Chief Claims Officer at Amerisure Insurance Company. Amerisure is a property casualty carrier. I would say we're a super regional. We do about just shy of $900 million of business annually. Our focus is in construction, manufacturing. We do a fair amount of workers' compensation business. And when we talk about inflation, I look at it, there's economic inflation and there's social inflation. For Amerisure Insurance, really, we're more impacted by social inflation than anything else. We write a lot of casualty business. We have a general liability, auto BI. And so, my perspective when we have these conversations really is from a social inflation place. And that's probably what I'll be focusing on.
Okay, great. I'll be right back with you in a second. Next up will be David Van Alec.
Good morning or good afternoon, everyone. My name is David Van Alec. I am the Chief Legal and Compliance Officer of Richmond National. We are a surplus lines insurance carrier based in Richmond, Virginia, although we are authorized to write business all across the United States, as well as Washington, D.C. We write commercial lines, specialty lines products for small to mid-sized businesses, which generally entail, general casualty, excess casualty, professional liability, allied health, commercial property, and products liability. My experience with respect to the social inflation and claims inflation issues tend to be with respect to litigated claims. It's within my purview to provide guidance and insight on bad faith extra contractual issues, as well as product development. Prior to joining Richmond National, I was 14 years in claims within a large international global carrier within the professional liability claims organization, as well as their head of operations. And then prior to that, I was in private practice in San Francisco and Chicago, working for various law firms on professional liability defense and commercial litigation. So from my perspective, where I'll be speaking to the issue of claim inflation will be on not on personal lines or the admitted markets, but more on the commercial lines in the surplus lines space.
Great. Well, I'm going to go to Steve, but everyone feel free to jump in on this and just talk about first on the question of, what is causing the claim inflation? And, Steve, feel free to go into talking about the social aspect of.
Yeah, so really one of the things that we're seeing, obviously social inflation is really been magnified since the pandemic. I think we were hopeful when we went into the pandemic, right? Social inflation was something we were experiencing before that. We went into the pandemic to a degree, right? Courts shut down a little bit, got a little harder for claimants to get treatment. And coming out of the pandemic, I think we're realizing now that social inflation has just taken off even more than much more than it had prior. I believe there's a few things behind that. One is the reptile theory is playing a part in driving that. And the reptile theory really is a way that the plaintiffs have changed the way they approach litigating claims. They're moving the focus from creating sympathy for the plaintiff to creating fear and anger towards the defendants. Is one big piece of it. Another is I think they've changed their philosophy. It used to be plaintiffs' attorneys when I was practicing, and probably when David was, they were very hesitant to ask for a big number. In closing, they were afraid it would make a ceiling. And today, their attitude, I think, is the bigger the better. And they didn't, they don't want to look greedy in the past, and they've recognized that really hasn't been a problem these days. So I think that's one big thing. It's over the pandemic, I think the reptile theory has proliferated across the country. There's many more attorneys that do it. We used to be able to kind of target the lawyers that did it and the locations and handle that a little differently. And I think we're at a point now where that's really changed, and you're seeing verdicts across the country, huge verdicts in places that used to be what we felt were moderate counties. So that's one big piece of it. I think there's another that really is more of a socio-political kind of a situation where jurors are angry at companies and corporations, and they feel like often serving on a jury, this maybe is their opportunity to kind of to get back at them, and that creates this dynamic that is running up some of these really high jury verdicts.
So the reptile theory and the juries are kind of creating these like nuclear settlements.
Yeah, nuclear verdicts and settlements, right? There was just to name a couple, there was a verdict against the crane company in Texas for over $800 million. It was a wrongful death. Texas has a limit to punitive damages. So, the jury, if you strictly read, the way they're supposed to come down with verdicts, the jury felt like the decedent's family, it was a single woman, no children. Her parents needed, hundreds of millions of dollars to compensate them for the loss of their daughter. And in the past, that just, wasn't in the realm of possibility pre-pandemic.
Are there other issues also causing, and David, if you guys also feel free to also jump in, but are there other things also besides just the jury verdicts that are also causing issues like labor shortages?
Yes, I definitely, apart from the, Steve's comments, which, I wholeheartedly, agree with, especially the proliferation of the use of the reptile theory, which is a mechanism or way for, attorneys to, I'd say, exploit, but really amplify, the failures of following, policies and procedures with respect to a defendant. And it may not necessarily entail what was the causal connection with the injury that may have taken place, but it's these other issues that they just keep chipping away at that ultimately gets folks very, very upset and infuriated because they envision or imagine themselves in the shoes of that particular plaintiff or a family member in the shoes of that particular plaintiff going, would I want, myself or a family member being in that particular situation? I'd say almost not to regardless of what the actual, issues of liability and damages are, but that's kind of what drives a lot of the reptile theory approach. But one other key thing that's been talked about for quite some time now, but it's again continuing to amplify, especially as we're coming out of the pandemic, is the use of litigation funding and litigation funders in particular. I was just looking at an article from Reuters from February of this year, where they had mentioned that litigation funders in the U.S. were overseeing about $13.5 billion with a B, billion dollars of assets under management. And for those who are on the line who may not be familiar with litigation funding, that is where, whereas historically maybe it would have been more expensive for a plaintiff or their attorney to bring a case to further along or to trial, and there are investment companies at this point which will provide funding to the plaintiff and or their attorney in exchange for a percentage of a potential outcome, and it's basically treated as an investment vehicle. So with $13.5 billion of assets under management, that's pretty significant. Last year alone, according to that particular Reuters article, there was about $3.2 billion invested in litigation last year. That was a 16% increase year over year. And it doesn't really look like that's slowing down. So you have this confluence of events with the societal issues, and I would say a general corporate distrust of corporations and companies that's taken place, coupled with the reptile theory, coupled with a funding mechanism that's really amplifying things. Not to mention what I call, and again, being general chief legal and compliance officer, looking at the erosion of tort reform in general. Various states pulling back on caps on damages for certain types of injuries, that sort of thing. You see it here and there, but cumulatively that is also having an impact. I will say the one bright spot there is recently back in March, Florida passed some pretty significant tort reform in reducing the statute of limitations period for negligence claims from 4 years down to 2 years. Changing their state from a pure comparative negligence over to modified comparative negligence. There's a whole lot of things that are taking place, which will hopefully make Florida a more even playing field for all who are litigating there, on a go-forward basis.
Well, considering all these issues that are going on, what are you guys doing to combat this? Like, what are ways that you can automate or empower your teams to be able to handle this growing inflation?
Yes, so maybe I'll chime in here. So I think the genesis of a lot of what leads to the litigation needs to be discussed. In Texas, we're starting to see the patterns that Florida and Louisiana have been battling for years, where the bad actors come in and manufacture losses and encourage policyholders to push for money because it's a nothing to lose environment and getting worse. And I think the biggest thing we're seeing right now is the bad actors getting up, going door to door, telling policyholders, hey, I got your neighbor a new roof. Let me go up on your roof and inspect it. While they're up on the roof, they manufacture the damage with a hammer, a spoon, or a coin, come back down and say, yeah, you got damage. I can help you with your claim. They get them to get the policyholder to sign a contract, and they don't understand that contract may include bringing in a public adjuster or attorney. And by the time the policyholder figures out it's too late, what we do to combat that is, we send out trained licensed adjusters who, in most cases, can identify the difference between naturally created damage and mechanical damage. But if there's any question, we'll pay to send an engineer out to confirm whether it's covered damage or not. And what happens is we either pay for repair or replacement of the roof, or we deny the claim because it's a form of vandalism in many ways. And what happens is the poor policyholder gets caught between us and their representatives, and they don't get a new roof. All they get is delays in action. They may have a marked up, damaged, vandalized roof, and now their only recourse is to consider litigation. And maybe 2-3 years down the road, they might get something or not, and they're left with a bad taste about the whole process. They don't like the insurer any more than they like the people that were representing them. But the method and process we use is we'll consider trading expense dollars, which typically are 3 or 4 digits, if we can avoid paying non-valid claims, which could be 5, 6 digits.
Are there ways that you can use different kinds of analytics to be able to help weed out some of those, bad fraud situations?
Yeah, like most residential property insurers and commercial insurers, we rely heavily on Exact analysis, Xactimate, the estimating software. And, they constantly update and keep the pricing, but it over time, it becomes a moving target. And more when you have storm after storm after storm in areas, contractor shortages drive cycle times even longer. The longer a claim stays open, the more likely you're going to have variability in labor and material costs. And you just have to keep up with it and move with the policyholders, so that we go out there and provide the initial estimate. Months later, they get a contractor estimate. Months after that, they start the repairs, and in the course of 6 to 12 months, you may have to make 1 or 2 supplemental payments or more because prices have fluctuated. And typically, as we've seen over the last 3 years, they're not going down.
Yeah.
One thing, we just signed up, many companies are doing this. We're running a pilot with Xactimate where they partner with ITEL to provide real-time pricing for the roofing materials, whether the policyholder chooses to use that or not. So at least we have a method now for getting a replacement cost for the like kind of quality shingles that's in the estimate, rather than guessing with a generic type shingle.
Steve, do you have examples of how you've been able to improve productivity, or ways that you can be able to use analytics to help with the claims handling?
Yeah, so for the social inflation piece, one of the most important things is identifying the claim early, identifying claims that are likely to either be subject to a reptile theory approach in litigation, or likely to escalate and become more valuable over time, getting them to the right adjusters at the right time. So there are a lot of quite a few organizations out there that are have either developed or are in the process of developing tools that help you identify these things. That's something that's been around for workers' compensation for quite a while, and for auto BI and GL, personal injury, third-party personal injury claims. It's a little bit newer, but there are quite a few companies out there that are doing it. One of the things that's so important, and one of the things that makes kind of the reptile theory so unique, is because the strategy and the arguments are different, you need to change the way you defend them at the very beginning of the case. They're one of the one of the really interesting things. Suddenly hiring practices are a much bigger deal than they had been in the past. And if you're not prepared for that, and you don't understand it until the deposition of your corporate representative goes, and that goes badly, now, the horse is out the barn, and you've got suddenly what felt like a small claim, it gets very escalated. The same thing's true with attorneys. A case may start with an attorney that generally doesn't use a reptile theory. The strategy isn't going along a reptile strategy. And then suddenly, 3/4 of the way through, another attorney will parachute in, totally change their approach. And if you aren't prepared for that, and if you haven't been defending it appropriately, you'll find yourself in a bad position. Ultimately, social inflation means it's so much more important for you to really prepare for litigation, to provide the best defense you possibly can, because they're looking to set up companies that aren't aware. And so understanding that early on, historically, there was less of kind of a setup situation, and you could resolve things. And I think a lot of the plaintiffs' attorneys now are waiting to see how defense attorneys, how insurance companies are responding, how well they're defending. If you do a great job defending, you probably can resolve it for what, is somewhat of a reasonable number. But if you're unaware, that's when you end up having to litigate something and get really whacked. So that's one way. Probably, the technology And I think it'll continue to get better. It is still early, but that's one big way to help avoid it.
Yeah, and just to kind of piggyback off of Steve's comments there, Kate, to Steve's point, being able to use, technology such as, OCR technology to kind of read through, the lawsuit, the file as soon as it comes in. I always give the very specific example. If the operative pleading that's come in is when the claim is reported is from, one of the top 3, plaintiffs, firms in, Florida, for example, if you don't have the ability to triage that and recognize that's potentially a severe claim, and it just kind of goes through the normal motions, if your claim operating model isn't set up in such a way to have a complex team, a mid-level team, and maybe a high frequency, low severity team, that suit may end up in the hands of the low severity team, through no fault of their own. With those individuals not necessarily recognizing that they've got a pretty dangerous claim on their hands, not because the allegations are specific, but because of who is coming to bring that particular claim. Whereas if it had gotten routed over to a complex team, that team would have been, very familiar with that particular attorney, would have presumably approved panel counsel and attorneys on their list that have gone toe-to-toe with that particular plaintiff's attorney before, thus driving a potentially better earlier resolution. At least it's leveling the playing field a little bit more. So yes, go ahead, Steve.
One of the things, and David, really excellent point. One of the things that's changed in the last several years is what might feel like in the beginning a pretty mild case, relatively innocuous, not a lot of severity, because of social inflation, and the right attorney can turn it into a really big, dangerous case. And that was less the case before. And David's right on the mark. You get an adjuster who doesn't recognize that that's happening, and all of a sudden it's a month out from trial. Your preparation has been inadequate, and you're stuck. Whereas, in the past it was a little easier to say, oh, this is a big, dangerous one. We need to make sure the right people are on it.
Yeah. And I've always been a big advocate too of kind of periodic sweeps, through the file, because the initial plaintiff's attorney who brings the case, if they are coming up on trial, may parachute in a trial attorney from one of those premier firms. Again, if you don't recognize who that firm is at first, there's going to need to be some additional eyes to assist with its ultimate resolution. So yeah, it's the technology coupled with having the right teams set up in the right way to really leverage and put everything on a level playing field to combat claim inflation.
And even a panel designed to defend it, not only the adjusters, but we have specific attorneys. And actually, I think one of the industry's big needs right now is we need more attorneys that understand how to respond and defend against the reptile theory. And the more of those that we have, the better able we'll be able to defend that.
So I'm getting a question or two from the audience, but before I go to that, is it just knowing, obviously you need the skill set once you know, but is it just knowing like who the top attorneys are so you can put that against it? Or what is in that technology that you're saying technology like is helping, but what is in the technology that is really helpful to be able to identify which claims are going to be able to potentially have that spark or be able to turn it into that? I mean, it's obviously the skill level of those top firms that you're talking about, but what is making that potential thing that the technology is helping you do?
I mean, from my perspective, it would be, a matter of, identifying, who the players are, being able to identify the specific jurisdiction that you're in as well.
Right.
Right. I mean, there's publications on, judicial hellholes and that sort of thing that gets updated on an annual basis. And, every, good claims organization has that somewhere on their desk just so that they can recognize that. But it's very difficult to kind of keep that top of mind. And that is shifting, fairly routinely. And so some of the newer spots you wouldn't necessarily, if the technology can kind of read through the complaint or the file and bring that to light, that would be helpful. Depending upon what the particular allegations are. It might be able to assess on a scoring, level, the level of, or the extent or severity of a bodily injury or the level of property damage that's at play. Whether they're seeking, punitive damages. I mean, or making allegations of fraud, which, those types of things. So, some suits, might be, relatively straightforward and simple, and could be, relatively benign, but others are probably going to have some of these, what I call, red flag indicators that, to the extent, that's reviewed and technology can assist, the claim managers, the supervisors, the directors, or what have you, directing those to the proper person with the right skill set who can recognize that that's what is taking place. Again, that's going to give, the carrier, the policyholder, counsel, the tools earlier on to be able to make that particular assessment. So, and I don't think that stops right at the beginning. I do think that there should be periodic sweeps, because things can, potentially head south very, very quickly. You may have a key witness that all of a sudden has gone, potentially missing, some core documents or key documents that potentially, or evidence that has been spoliated or allegedly spoliated. Those are things that are going to provide or have some heat when it comes to severity, which is definitely going to increase overall indemnity on those files.
Well, and I think, David, you hit the nail on the head. It's the red flags, and a lot of the red flags are the same red flags you're using for your fraud mitigation tool sets. Mm-hmm. So late reported claims, delayed reported claims, claims reported by someone other than the policyholder, typically a public adjuster, contractor, or attorney. And then, when you look at the analytics you can get from your fraud mitigation providers, are they habitual claim filers? Are they not only filing automobile claims, but are they filing workers' comp claims, slip and fall claims, automobile, a variety of property claims, and some of the more modern tools, Shift and Frisk. Now you're starting to look at unstructured data, web crawling, and finding out who are these people out on the internet? Are they really who they say they are? And again, back to the habitual claim filer, but also, can you see, are they using aliases or deep fake information?
Mm-hmm. And for BI, third-party BI, ABI, and GL, the technology is very new, right? There are quite a few companies out there working on it, and developing it, and it is available out there to use, but it is really, really new. My expectation is in the next 2 to 5 years, there's going to be huge advances in how good it is at identifying these things, how specific you can target developments in that, and I agree. OCR really makes a difference because it allows you to monitor it as the new documents come in. It's continuing to update when things change. But it is very new, particularly, comp, it's been around for quite a while, but for BI, it's a lot much newer.
We have a question coming in. Do you believe that social inflation has made the greater stratification of claims handling terms more critical?
Absolutely. Absolutely. It's also, I think it's behind some of the staffing issues we have. Suddenly, the value of these most complex handlers, right, our top technical specialists, the impact that they can have is much greater than it was 10 years ago, and as a result, everybody's scrambling to get more of them. And at the same time, they're retiring. A lot of them are reaching retirement age and leaving the market. So that definitely is true, and it creates a whole nother problem.
Well, just to think about that, like how best to prepare your teams for this, and like how can you better upskill your current teams?
I think it starts with having the right people in the first place and taking care of them, but somehow you've got to develop people into those players, because sooner or later they're going to leave, and you've got to replace them. And it's very challenging, especially as Steve mentioned, with the higher experience, higher skilled people, but those people can be used to mentor. And sometimes you have to challenge folks who don't have the skill set and mentor them and hold their hand along the way until they're ready. But you know, especially commercial property, commercial lines in general, there's a huge shortage of expertise. And if you can find the right people, you got to figure out how to leverage their skills to develop other people.
And Kate, you know, kind of piggybacking off those particular comments, and I know it's, kind of speaking about, talent in terms of, acquisition, retention, and the importance of, creating a strong, culture. Where, for example, here at Richmond National, I mean, our value statement is, we empower our people, to, come up with creative, solutions, in meeting and responding to the needs of the customer. But I know, I view kind of the talent issue as not just within a claim organization, but I view it as more holistically, in terms of across the carrier organization, to responding, your question at the outset of, how do we combat claims inflation? I view it starting with underwriting. To be honest, it starts with them in terms of modeling, trends in claim inflation, in terms of frequency, severity that they're seeing on those particular products, and managing that at potentially the portfolio level. There needs to be, a huge amount of, talent and data that's, speaks to that particular area. All that rolls into disciplined, rate monitoring, as well as, proper premium pricing. That's not just, including what I call general inflation. And I know this topic isn't about general inflation, but we all know that, general inflation's been, significantly on the rise over the last couple of years. I think it's cooled down to around 4% currently, but social inflation in essence sits on top of that. And then also, contract management. What was the policies and the terms and conditions of the policy say, and are we, as carrier organizations fashioning them in such a way to, mitigate against some of these social inflationary effects. And then, beyond underwriting, risk management. I think every good carrier recognizes that one of the best ways to combat social inflation is by having a strong risk management program. Whether they do that internally or outsource that to third-party vendors. I think having strong risk management resources available will not only mitigate claims, but potentially reduce the number of claims, which will then feed into a positive cycle of reducing social inflation as a whole.
Yeah, I don't want to hit on reptile theory too much, because it is not the only thing that's driving it, but it is driving more change probably. And David's point about risk management, if you think, historically risk management's focus was about avoiding injuries, and it doesn't mean that should change. But today, if you take the reptile theory into account, risk management is also about all those things that come out that aren't necessarily related to the particular incident that the litigation's about, but that will create this anger among the jury. Like, are they living up to their standards in their hiring practices? Are they doing, are they doing a proper review of people's driving records before they bring them on board? Do they follow their policies around discipline if people are getting DUIs outside of work, things like that? All things that maybe don't directly impact the accident itself, but that will impact the outcome of a trial if it becomes part of it. So it really does change the way we approach risk management as well, and frankly, underwriting too, right? They should be looking at the same things, and it is a little bit different now that we're adding that wrinkle.
Let's get some more. We're getting a bunch more questions from the audience. So do you recommend that carriers be prepared to pay more in legal expenses to potentially save much more, potentially in indemnity?
Yeah, I know my own personal thoughts on that it certainly is a great way to go, because in terms of I know historically, and this goes from my days in private practice, the billable hour is basically the framework that we work under. And, sitting in, a carrier organization, looking back on it, the financial incentives is not necessarily as aligned with respect to, that particular, financial model in a law firm from a claim organization. But if there are ways to, create alternative fee arrangements, maybe fee caps, building in success bonuses. I know that's been talked about for some time, but I think if we're able to, build a structure in such a way that may incentivize defense counsel to, take a chance on an earlier dispositive motion, like a motion to dismiss or motion for judgment on the pleadings, even before motion for summary judgment, to potentially resolve the claim earlier. If there's a success bonus or kicker, included within that, I think that may create more financial alignment. And yes, you'd be paying more in legal expenses up front, but you would be drastically, positively impacting the indemnity or loss associated with that litigated claim. And because we all know that those dollars are significantly more than the expense costs in any event, I think the marginal or incremental increase in defense cost would be, more than offset by the reduction in indemnity.
Yeah, this actually is very similar to what we were talking about with the adjusters, right? The impact that the lawyers have on the outcome has become greater, so the value that they add to the case is greater. And my advice to anybody who has any sort of frequency around these high severity potential claims is don't be penny wise and pound foolish. You do not want local slip and fall attorneys defending these high severity claims. When the plaintiffs are parachuting in, plaintiffs attorneys from LA, Miami, wherever, you need to make sure you've got the same quality defense attorney in there defending it, and if you have to parachute them in, do so. We have a panel that's for this kind of these type of litigation, and we also have a group of attorneys that are willing to parachute in on short notice when we need them in places that we don't have covered with the panel.
How do you make sure you have the right people on the panel?
That's a good question. So we've gone to, there are a couple experts in this defense work. There's actually one of them in Chicago. We have a great long relationship with, very trusted. We've done business with him for decades, and we know he's top-notch lawyer. Another one in California who wrote the book on defending the reptile theory. His name's Bob Tyson. We've retained both of those firms to help us assemble a panel, and they help us identify where the best lawyers are at defending these kind of cases throughout the country. And we actually we have our panel attorneys helping us build out a better panel. Or we've done.
So you have a panel for a panel?
Yeah, right. That's about it.
So I think you guys have addressed this, if not directly, indirectly, but is overall inflation driving up the rates for policyholders? And if so, will we also expect this to continue for the next 1 to 2 years?
Yes. This is, although I got to say, if you're talking about personal lines policyholders, Florida and California, what's been going on there, there's an element of it that I think is social inflation, nuclear verdict, but there's also a pretty big element, I'm sure, of it that's property driven, right? I know Florida is, and as well as California.
Yeah, and just to kind of, also kind of piggyback off of Steve's comments there, I think it also depends upon, the part of the market that you're in. The admitted carriers, yes, they're feeling the need for increased rates. They're approaching the regulators, seeking, permission to charge, higher rates, given kind of these social inflationary effects. Some are having success, maybe others, maybe not as much. But what I think you are definitely then seeing is, if there aren't solutions to be reached within the admitted carrier space, those potential accounts are going into the surplus line space. again, that's where, my particular company sits. And yes, we can definitely see where not just general inflation, but social inflation, continues to have some pretty, strong, upward pressures. I'm not one to, prognosticate on whether it will continue for 1 or 2 years. I think if you asked any of us back in the end of 2019, what does the next, 2 to 3 years look like? None of us would have imagined there would be a global pandemic and everything would have been, placed on its head. But certainly, at least directionally, things continue to appear that way. But I do think that with some of the the changes that have taken place out there, such as Florida's tort reform, that is designed, and they had property reform in December of last year as well. Those changes are designed to, bring more additional capacity into the state of Florida, which should provide, an easing of potential, rates for the Florida policyholders. So I think it's a wait and see, but certainly that there are, varying, various, variables and such that are potentially going to impact that.
I have a question specifically for David Williams. How are you preparing for inflation impacts when addressing cat weather events strategies now and looking into the future? And how are you trying to get ahead of more costly events with your preparation?
Yeah, so the biggest challenge is the surge pricing that we see, and a lot is dependent on not only what's going on in Texas, but what's going on everywhere else. Our greatest fear is that Florida and somewhere else gets hit with a hurricane at the same time, wildfires or earthquakes in California. Now Texas gets hit with a hurricane, and you can only imagine what labor and material costs are going to do by the time we get around to adjusting claims. So the best we can do is move as quickly as possible, get money in the hands of the policyholders, give them the guidance that they need to recover as soon as possible, but also give them the time. In the olden days, the whole battle with catastrophe claims was get somebody out there, pay it, and close the claim as soon as possible. And our philosophy's changed for 2 reasons. 1, because that old method doesn't work. 2, we have statutes that say we have to keep the claim open longer. So our plan is to be a guide with the policyholder through that long-term process. I don't know that we can control labor and material costs. Sometimes we get lucky over time and one or the other goes down, but generally over time they either stay the same or get worse. But getting them back to where they were is important. But the challenges that I think we're seeing are in 2 areas. One, in addition to getting rate increases because of social inflation and excess losses, policyholders are seeing the cost to rebuild going up, so the amount of coverage they have to purchase goes up, and they're not understanding that that's a way that their rates increase. And then the other is building codes have changed. So with all the disasters over the last 5 years, building codes have gotten stronger in many places. So now if they do have to recover, they may not have the excess coverage to pay for those upgrades to meet the building codes, and that's a challenge as well. And then of course, if they're in a flood zone and the FEMA 50% rule kicks in, now they may not be able to do the repairs. They may have to rebuild or raise the property up as they rebuild. So there's a lot of factors that impact the costs of repairing properties. And I think all we can do is try to understand the trends, what available tools and technology are out there, and try to be as quick and accurate, and most importantly, empathetic as possible to help those people, when they need us the most.
David, this might be a question more specifically for you, but maybe, but feel free, David and Steve, to also chime in. But have you found ways to be able to educate your base or your customers on to prevent situations from actually happening, or ways that you can tell them to from situations so they don't have damage and claims?
Yeah, so we would love it if we could get some sort of mitigation program in place like the Institute for Business and Home Safety has. I think Alabama leads the way. North Carolina is coming along, where people ruggedize their structures either after they've had a claim or ahead of that. Of course, the problem there is the average cost can be $2,500 or more. And unless there's some sort of federal or state funding, it's difficult for people to want to even adopt that kind of thing. But, mitigation is a big deal. We know from experience, I think everybody's seen the images, the properties that survived major hurricanes were more recently built to the stronger building codes, and for us, we wouldn't have policyholders if they didn't have those structures that were older and more reasonably insurable in the regular market. So it's something we have to deal with, but they still get the same level of service no matter what. But we've seen the struggle after Hurricane Harvey and the events in 2021 where some people, they don't have enough funding, either because they were underfunded with the amount of insurance they needed to do a replacement, or they didn't have building code upgrade coverage, or they had other factors. So there's a lot of things that go into it.
Oh, I have a question going back to the panels that we were talking about earlier, which was how often should you make sure you're rotating your panels around to make sure that you have the right number and the right and their knowledge on their jurisdiction?
I have an opinion that probably should be done, I'd say periodically, at least annually, if not, more than that, in large part, yes, once those particular, panels are put into place, some organizations just tend to keep the same firms and what have you in place. But I think given the nature of the changing, demographics, again, we all know that a lot of people, moved into new locations, during the pandemic. The nature of some of the historical data may have shifted. I think it's critical to recognize that there may be some differences in maybe, historically safe, jurisdictions that maybe they're not as safe for trying cases. And then conversely, there may be, jurisdictions that were historically a bit notorious, but have now actually are a little bit more reasonable. So I certainly think, having a periodic review of, the attorneys that are on your panel counsel list is very, very important. And the other part is the rotation through those particular firms and attorneys as well. There was a lot of attorneys moved to different firms over the course of the pandemic, and there are a lot of new attorneys that basically have developed incredible expertise in a particular field or jurisdiction, and you want to be able to identify who those individuals are and leverage those individuals as others retire. So that is a living, breathing document from my perspective.
Yeah, and I maybe this is obvious, maybe it isn't. You should have metrics around the performance of the firms. Average paid for a given severity, cost per claim handled. Again, you want to be careful you're not penny wise and pound foolish, but having metrics that you're running across your panel, and if you have the resources, having people out looking at auditing panel files and doing things like that to get a better understanding of the work they're doing and the quality that you're getting, and frankly, even there's a billing element there. Those are ways to keep on top of the quality of the panel that you have.
Okay. Can you comment on to what extent extra contractual exposure drives up the overall claim costs?
Yeah, go ahead, David.
No, you go ahead, Steve.
This is a big problem, right? So we're an organization, we have a lot of 10/1, right? $10 million in umbrella, $1 million in the primary coverage. And then because we insure a lot of commercial line companies, they may have another, whether or not there's another 10 or 20 above them or not, it creates a dynamic. It used to be you were pretty confident that if you were doing the right things and communicating and considering things well, and acting, extra contractual exposure was not a primary problem, and has started to change. particularly, so the risk, so what happens, right, is the question is, did you act reasonably in your handling the claim? Well, now that you have $800 million verdicts, you kind of look at it and go, well, I don't know, how reasonable is it? And it has changed the dynamic. And, the other concerning thing, as an example, the state of Florida, bad faith is a jury question. Well, we've already talked about some of the concerns that we have with jury verdicts and how they're ruling on things. If you're not confident in how they're ruling on the verdict, how can you be confident in how they'll rule on the extra contractual situation? And so, this idea that, well, we think the claim's worth 8 million, we have 11 million in coverage, but if we were to try it, we could get hit with 50 million, and then we got to fight an extra contractual. Well, does that make you go, oh, well, geez, I guess we'll pay 11? I mean, hopefully you're not doing that. And hopefully you're preparing enough that you can defend it, but that does create a whole nother wrinkle. Now, there's one other situation, and that is when you have layer over layer over layer. So let's say you have a 10/1, and then you have 10 more or 25 more, and then 20 more and 20 more. If the risk is you could get hit for $200 million and your limits are at 10, well, even if you don't think it's worth that, the idea that, well, I could pay another 10 more and avoid a risk of another 150, because by the way, all these carriers above me are going to say we should have settled it. That changes the dynamic. So there was just a settlement in Cook County, a settlement. One person was injured. I believe it was a bilateral amputation, serious injury, but it was a $96 million settlement. And I think one of the, which back in the day, $96 million, seems, not something you'd even consider. And one of the reasons is there's a layer and a layer and a layer and a layer. And each of these layers are kind of like, well, I have X amount in coverage. Do I really want to risk having extra contractual exposure for another $50 million? Well, no. So I'll tender my layer. And the next layer is the same thing. Well, we got 10 million. Now, do we want to risk another 40 million? And eventually it keeps going up to get these crazy settlements. And ironically enough, it's so now that there's a $96 million settlement there, the risk of bad faith is greater because the settlement happened, right? So that I think it's a great question, and it creates all kinds of other problems that, that I think a quick look at social inflation doesn't recognize.
Yeah, and just one thing to add on to Steve's comments, which I wholeheartedly agree with. Even not just the extra contractual exposure on a transactional basis is there, but what we saw in Florida with the tort reform that went into effect. I believe it was immediately on a Friday. And I believe, if I read the reports correctly, in the week leading up to that period, when they were anticipating it being signed by the governor, there were approximately 25,000 to 100,000 lawsuits that were filed to try to basically get those suits filed before the effective date of that new law, because of the significant changes it was making to Florida bad faith law, creating like a 90-day safe harbor period, that sort of thing. So the litigation, everyone was trying to get things locked in so that you could have the same rules apply that have applied over the last several years in that particular jurisdiction.
One last question before we kind of sum up, and we did touch about this a little bit, but more specifically, can you talk more about the power of AI and how you've looked at it for claims handling and augmenting your workforce for those high exposure claims and cases?
Yeah, I can chime in. One of the things, for total losses or heavily structured damage losses after a major hurricane, where you literally have thousands of these things, is change detection technology, where you get aerial images before the storm and then you have them after the storm, and companies will take that information with AI machine learning, do comparisons, and spit out a report that will tell you for your entire book of business how many claims you have no damage, how many light damage, how many structural damage, and how many are total losses. Why does that matter? Because 3 of those 4 claim severity types you can desk adjust. The only one you have to send somebody out on is the structural damage, where the property is still surviving. No damage, you just call and confirm there's no damage. Light damage, yes, policyholders submit their estimates. And total losses, you pay the policy limits and close the claim in most cases. So, that's a time-saving, cost-saving measure. And in some ways, you can be proactive, because if you get that information quickly enough, you can actually call people and open and resolve their claims before they even had a chance to report them to you, especially if they've been evacuated. So that technology is growing. And then we've got available to us a technology that will do the same thing for slab claims. Within 48 hours of a loss, we can tell where slab claims are located, and we can start resolving those claims based on the timing of the wind versus the surge. So surge isn't covered in our world, but the wind is. And we can pay a percentage of damage based on how much damage was caused by wind before the property was destroyed by surge. So there's, technology definitely has a role now, and will continue to have a role in the future for helping us move those larger losses along more quickly.
And Kate, and I know on the litigated claim side, while this is definitely very early days, and I know this particular panel discussion is not on generative AI or artificial intelligence, but we've all heard about ChatGPT, and the attorneys out in New York who provided a filing with before the court with like 10 false cases or bogus cases because the AI was hallucinating. But I think that there are some other potential solutions out there which are much more secure, transparent, and it's a matter of kind of training individuals. But the power of those particular tool sets is the ability to synthesize and summarize a great deal of written material in a fairly concise manner. And I think it's very, very promising. Given some of the things that we've seen are potentially available out there, and not just summarizing that information, but being able to pose questions in a much more natural way to those set of documents, to be able to potentially call out some of those more severe or complex issues, which will greatly assist in the claim adjudication process.
Well, just with the last few minutes, if everyone wants to give a quick summary and conclusion, Steve, do you want to start?
Sure. I believe social inflation is, we're still as an industry recognizing the impact. And I think it's still evolving, right? We continue to see, that settlement I just talked about as an example, that's a recent thing. And I think it is going to be one of, if not the largest challenges our industry faces in the coming years. We've got to come together as an industry and start fighting it as a group. Otherwise, it will cause real problems. That's my big hope, is that an industry we can start coming together, thinking about solutions, right? Not advertising about cartoon characters and all these funny things, but talking about the things that plaintiffs' attorneys are doing around litigation financing and some of the other things, so people understand what's really going on, and the fact that social inflation is real inflation, and the reason you can't afford auto insurance is because some of these verdicts. I think that's just critical, and I hope we're able to do that.
Thank you, Steve.
And I'll chime in. And I don't know that we can control the economic factors, but I do know we can control how we engage with our policyholders, agents, and other stakeholders. And I think the challenge for claims is to set expectations. I saw a quote that said, "People are very patient when they know what to expect." And what we learned after Hurricane Harvey was, as well as we thought we did, we still need to do a better job of setting expectations. And I think that will help not only move claims along to the enjoyment of the policyholder, but also maybe help curb some of this desire for social inflation and move to litigation. If you treat people right and treat them with empathy, it seems like it's an old cliche, but I still believe that's the best way to approach our business.
David, I think that's a great quote to remember. People are more patient when they know what to expect. David, do you want us to finish and conclude?
Sure, absolutely. Yeah, again, thinking about the general topic of combating claims inflation, I look at it, very holistically. And I think it's the entire, organization, carrier organization, and the entire, industry should be focused on it from, the underwriting side, the risk management side, and the claim side. It's not just a claims issue, right? It's much broader than that. And I think the best way to tackle those issues, and we spoke about some of those potential practical solutions today. If several of those are brought to bear, I think that's probably going to put folks in the best position to address the issue here in the future.
Well, that concludes our session today. Thank you, everyone, for joining. Thank you, especially to the three of you and those who submitted questions. I really appreciate it. Enjoy the rest of your Tuesday, everyone. Thank you.
Thank you.
Great. Thank you.